Everybody, welcome to 2nd of August 2017. Time has just gone 8:30. I'm very happy to be back at the trading desk after sort of what seems like quite a long time of interrupted activity for me. And one of the things I would like to start this market briefing on is just making sure that everybody's financial education is up to scratch. And the reason why I'm going to focus on this is looking at Deutsche Bank's read this morning. I'm sure you've read this research that's been sent to you. Can you see that many in the market continue to talk about the carry trade until Jackson Hole in 3 weeks' time? Now, the carry trade is something really that I learned deeply about back in the early 2000s when everybody was selling Japanese yen to buy pounds or US dollars because the interest rates in Japan were so cheap. And given what we're seeing in currency markets now, I thought it would be worthwhile if I gave you a mini lecture on the carry trade, what it is, why it's important, and why it's impacting currency valuations as we see them today. First of all, the type of currency valuations that I'm talking about are, as you see on the screen here at the top of my chart. So for example, chart 1 here, we're seeing the euro versus the USD reaching new 2.5-year highs here. So here's that sell-off in 2014 when it was apparent that the Fed would be able to start leaving their ultra-accommodative monetary policy. This was dollar strength, aggressive dollar strength that really weighed on currency markets as well. The euro today, as I speak, is trading therefore on a multi-year high versus the US dollar. But it's not just the euro. Let's have a look at the pound versus the US dollar. We have regained the majority of the moves lower since after the Brexit vote. Obviously, the Brexit vote, this relatively large red candle here coming from 150 all the way down to 131. There's the day of Brexit for sure, but anything after that has now been recovered by the pound versus the euro and the handle, that level that we've all been looking at, 130, a distant memory as the pound continues to strengthen against the US dollar. But it's not just the pound and the euro that are strengthening against the US dollar. Incredibly important if you look at things like the Australian dollar. So here the Aussie dollar versus the US dollar also hitting a new 2.5-year high. There's that strength in the dollar seen halfway through 2014. Now it's the US dollar that's the poor cousin of nearly every other major currency out there. And why is that happening? What exactly is going on? Well, there's a certain strategy called the carry trade. And I'm going to just take you through a couple of slides here to talk to you about the carry trade, how it works and what it is. Let me just set up this slideshow. And if I transition. So what you can see here with the carry trade on this lecture is that the strategy is quite simple. If you believe that US interest rates, for example, are going to stay low in the medium term, but the US dollar isn't going to weaken too aggressively, or there's going to be relative stable currency strength. Can I just check? You can see my lecture slide here. Type Y if you can see the lecture slide. Good. What you can do is borrow money in US dollars. Okay, so you're paying the US dollar interest rate, and you can buy currencies that pay a higher interest rate. Now, it's not necessarily the euro, obviously, here as an example, because the euro or the pound, they're giving a lower interest rate, but it's the US dollar that's being used to fund the carry trade, at least until we get to Jackson Hole. What people are saying there is they don't think that the US dollar will be able to strengthen for the 3 weeks leading up to Jackson Hole, and therefore it's quite safe to enter into a carry trade using the US dollar. And I'm going to explain exactly why that's the case. It's especially important when we look at foreign exchange differentials. So you can use US dollars to buy Aussie dollars. You're only paying the US dollar exchange rate. Okay, you're only paying, the interest rate at the central bank, the Federal Reserve, but you're receiving the Aussie dollar rate. So it's 1.5 to over 4.5 in terms of the Aussie dollar rate. So you can see how that carry trade would be possible. The return on carry trade, therefore, being whatever interest you receive on your Australian dollars compared to whatever interest that you have to pay in order to have borrowed those US dollars. Okay. Now, the reason why the reason why this carry trade will only be effective for the next 3 weeks, however, is because there can be a big problem here. So often the carry trade is called picking up pennies in front of a steamroller. And that's because if you're looking at this interest rate differential over, for example, let's say the next 3 weeks, obviously you can earn more money by holding US dollars than you can, Aussie dollars than you can US dollars. And that's all fine unless, however, the value of the Aussie dollar then appreciates too greatly compared to the US dollar. Okay. So it's not going to work, for example, if you're borrowing US dollars to buy Aussie dollars, and then after you want to finish the carry trade, you've obviously got to buy back US dollars and sell your Aussie dollars. And if in that time you've had an adverse currency move impact your holding, then you can lose a large amount of money. And that would way, way override the money that you would make on the interest rate differential. So you're looking for these currencies to be relatively stable. And so here you've got ST+1, that's the difference in exchange rate at the end of the trade compared to the exchange rate at the beginning of the trade. Okay, so the strategy here is, given that they don't expect the US dollar to move particularly aggressively over the next 3 weeks before Jackson Hole, it's a relatively safe trade, assuming no disasters. Now, just going to some of the theory then, actually, according to uncovered interest rate parity, of course, the carry trade shouldn't really be a profitable trade because the interest rate differential should mean that the change in the currency valuations actually make this trade unprofitable. Okay, because if you are going to be using a low interest rate currency to fund a higher interest rate currency, the change in the valuations of those currencies should actually, in a perfect market, negate the money that you would make from the interest rate differential. However, it's not always perfect, and as you know, markets don't clear quite as they should. And so imagine this as a leveraged position. This is the thing with a carry trade, why they can be profitable but also incredibly dangerous. What I mean by this is, if you can borrow, for example, 100, if you're using small amounts of money, then the carry trade, you can see, okay, you're not going to make a huge amount. Interest rate differentials on a 100,000 Aussie dollar trade funded by JPY, you're going to be looking at $12 a day. If these are the two comparisons of the interest rates, 4.5% to 0.01%. However, imagine then borrowing 100 million. Sorry, here I want to say buying 100 million Aussie dollar funded by JPY. Then in this case, you're looking at a much larger return because your leverage is so high. So the return on your investment being many times greater than the money that you've used to put up front in order to take this trade. So as long as exchange rates stay firm, this is profitable. So this is the carry trade. This is what's been going on, certainly with the US dollar leading up to the Jackson Hole. And it does remind me of, leading up to 2000 to 2007, during that 7-year period, the carry trade was all about the yen. I remember this, some of the traders that I was trading with, they were actually buying their London homes by borrowing money in yen and transferring that into pounds in order to buy the houses, but pay the interest rate, obviously, on the borrowed yen, which does make sense as long as the yen does not move against you in this carry trade, which is what happened in 2008 and caused a huge, colossal loss for many of the traders out there. Okay, so if you've got any questions about the carry trade, let me know. I'm happy to answer them in the room. Essentially, the core principle is very simple. Borrowing money in one currency that pays a lower interest rate, or that you have to pay a lower interest rate on, using that to buy another currency that you receive a higher interest rate on, that's a carry trade. All you have, therefore, is a cost of carry. How much does it cost to put on that trade, but also be careful. Any moves in the interest rate often can, sorry, any move in the currency valuation often can very sharply negate the positive carry that you might have on your carry trade position. Do feel free to ask me any questions as we go through the day. So going back then, looking at yesterday and what we had on the data front, just very quickly, obviously we had, well, I'm going to talk about oil in a moment. Before I talk about oil, let me talk about the European manufacturing data. So this is European PMI, Euro Area Manufacturing PMI. So slight, well, if you look at the trading economics chart, it doesn't look too strong, all revised lower. So Germany came out at 58.1 versus 58.3, lower. France 54.9 versus 55.4, lower. And the Eurozone overall, all revised slightly lower. In the UK, we had 55.1 versus 54.5, cue all the Brexit cheerers. So the UK being the sort of outlier there, the only one to beat. So slightly worrying data out of the European Union, but it's the summer period, it's the summer lull. I think to put it into perspective, you really need to look at the chart, the long-term trend that we've seen in European manufacturing PMIs. It's been a very strong year, to be honest, and okay, we've had a slight dip, a slight retracement on the readings yesterday, but nothing to worry too much to worry about. Yeah, I'm being asked to send out that PowerPoint about the carry trade. I will do that. I just want to make that change on the JPY Aussie dollar, so I don't confuse you when you read it. Okay, so we had European data out yesterday, but more interesting was actually what happened in oil. So we had API data out last night. If I bring up our oil chart, you can see the move in oil. We went from 49.25 down to 48.56 in a very quick succession on CLE. So here we're looking at a drawdown. We were expecting on last night's API. Let me see if I can bring up the stats for you. One moment. So let me just transition my screen. So, you were looking at that yesterday. So for oil, yeah, we were looking at a drawdown of 3.1 million barrels. It actually came as a build of 1.8 million barrels. So huge build compared to the expected for oil there. On Cushing as well, we're expecting a drawdown of 700,000 barrels. Now, just for you newer traders, Cushing is the storage facility in Oklahoma. This is where the United States holds most of its oil supply, and it's a very important indicator for US oil supply and demand differentials. So Cushing as well, we've got a build. Gasoline, we're expecting a drawdown of 1 million. We only got a drawdown, we got a drawdown of 4.8 million. So that is interesting actually. So all right, we've got a bullish on the gasoline number. If you want to look at gasoline prices and gasoline data, the code is RBE. RBE for gasoline. Now, this is quite interesting, therefore, on gasoline. Here, you can see actually that is an interesting drawdown. Who can tell me what does this mean for refiners? Does this make refineries in the United States more or less profitable? Put your answer in the room. An unhedged refinery. Does this make an unhedged refinery more or less profitable? Answer in the room, please. 10 seconds. Does this make an unhedged oil refinery more or less profitable? Just type an answer in the room. Doesn't have to be right. I just want to see you commit. Anybody? Safe? I can't see anybody in your room having typed yet. So, think about it. The price of what they are importing, oil, has gone up. The price of what they are exporting, gasoline and distillates, the price of what they're importing, oil, has gone down because supply is higher. The price of what they're exporting, gas and distillates, has gone up because supply is lower. So if the price of what they're importing has gone down because supply is higher, and the price of what they're exporting has gone up because supply is lower, then this makes them more profitable. Good. Good. Excellent. In the trading live room. Well done. And new traders, well done. Safe your room should hold their head in shame. Okay, so yeah, this is interesting, isn't it, from a distillate perspective, certainly, but also it's interesting and important for us because we have oil data coming out at 3:30 today. So have a look at your trading live stats. What are we expecting? Well, we're expecting our weekly crude stocks. Now, this is just for US oil, not Brent oil, of course. We're expecting US stocks to have a drawdown of 2.9 million. Similar to what we're expecting for API. Okay, so bear in mind how API has, if you like, disappointed the oil price. We've moved lower here on last night's data. We've actually only moved back to, I mean, oil had a huge move yesterday afternoon, really from about 4 o'clock to 6 o'clock, 4 o'clock to 4:30, sorry, we saw the main move in oil. This second leg lower is the move in API. So the move has been priced in to some degree, but I think, yeah, you'd have to see this 3:30 data today out of the US really show quite a significant build to spook the markets at all. Conversely, if you do see a large drawdown, as expected, then you should see oil test $50 certainly. Either way, it makes our 3:30 data much more interesting. Okay? Either way, it makes our 3:30 data much more interesting. I'm just being asked a couple of questions in the room here from Anne Naomi, hello, Anna Naomi, and from Marini, hello. Sorry if or Marion. Could I send the slides? Yes. And in practice, is it possible to book profit in a carry trade if you also entered an over-the-counter future contract on the future exchange rate? Yes, it is. So Marion's saying here, surely you can hedge a currency differential with an over-the-counter contract to hedge the future exchange rate volatility. Yes, you can, Marion. However, one of the problems with that is very often the profit that you're making on a carry trade for the size of the trade is quite small. You're just making an interest rate differential. So what you have to be incredibly careful of is costs. And entering an over-the-counter trade to hedge a future exchange rate, especially if you're looking at an option, for example, where you have to pay a premium, then cost can be something that can negate the profitability of a carry trade. But yeah, absolutely. If you can find a carry trade with a large enough differential that allows that profitable carry to pay for insurance to hedge against exchange rate volatility, absolutely. That would be a worthwhile strategy, certainly. It is more profitable if you don't need to do that and you don't expect a huge amount of adverse currency volatility, which is one of the reasons why Deutsche Bank was talking about the US carry trade only leading up to the Jackson Hole event that comes out in 3 weeks. Okay, so oil was one of the main ones. Today, by the way, so looking forward to today, I'd say it's relatively quiet, apart from the fact we've got, well, at 1:15, we've got ADP employment data. ADP employment data. Now, this is important because, of course, we've got non-farm payrolls coming out on Friday. Now, if we go back to last month's non-farm payrolls, it's been a really tricky one to trade, actually, because of, let me go to the last month's non-farm payrolls and I'll be able to show you. Hold on. Okay, if I just, I'm still sharing that screen, so you can see my Bloomberg screen. And if we look at last month's payrolls, it was a real shock, wasn't it? We were looking for 170, yet the actual data came out at 222,000. We were looking at a 4.3 unemployment level. This came out, however, slightly worse than expected at 4.4. Private payrolls was much better than expected. However, what was interesting is so really the two main ones here were the revision. Look at the prior was 138, that was revised to 152. So the headline was very, very, very strong. At last month's non-payroll, the headline was very, very strong. but the average hourly earnings was actually slightly weaker. And I was trading this non-farm payrolls data when I was in Shanghai, because in China it was 8:30 Chinese time, and it was the initial. It was volatile, but actually you got some initial dollar weakness of this average hourly earnings, which created a pop higher in T-notes, a pop higher in gold. That only lasted, I would say, about 5 to 15 minutes before then the dollar started strengthening again of the sheer strength of the consensus and the headline being revised. So employment data in the US has been strong in terms of the headline rate. What is really important, especially given that Jackson Hole is then going to be obviously less than 3 weeks' time, what's really important, guys, is to look for any sign of a change in wage price inflation here. Because what you have at the moment, and one of the reasons why US stocks are looking so supported, I haven't even talked about US stocks at the moment, I haven't even mentioned Apple at the moment. If I just share to my, change to my stocks chart here, what we haven't mentioned with US stocks is one of the reasons why we're seeing such a positive return on US equities here is, of course, the Goldilocks scenario. There's a lack of wage price inflation in the US. However, there's enough, if you like, headline job growth and just about enough growth in economic data, which is supporting equity prices. But it's not looking at it's not looking like the Fed are going to be nearly as hawkish as they communicated us that they would be. Does anyone in the trading live room, for the experienced team here, Ola or Dare or Michael, does anyone here, Dimitro, safe? I mean, this sounds like deja vu, doesn't it? For 3 years, the Fed have been trying to move interest rates higher. For 3 years, we've had Janet Yellen communicate her forward guidance of 3 or 4 interest rate hikes throughout the year. Yet it has never so far been possible for them to commit to this forward guidance. Anyway, so Goldilocks scenario supporting US equities. I mean, I'm just finding, you know, I'm coming back to the markets after working for, who have I been with? I've been with Deutsche Bank, I've been with Bank of China over the last few weeks. So I'm really trying to get back into the swing of things. And I just, catching up, it's just amazing, isn't it, to look at this chart of the S&P since 2009. And just as a reminder, I mean, it's phenomenal. I have to let this go. The fact that if you look at the actual move lower here, that's 58% from a move lower. We've now had a 280% move higher. This slight correction here in 2008 looking more and more minor. In fact, it's almost like we've had, so what are we looking at there? We're looking at 900. You know, we've had as much of a move higher since just in the last 2 years than we did for the whole of the credit crunch. So it's phenomenal, the move in these equity markets, but you just can't you can't get in the way of this. This is a perfect environment for US equities, and those people that have been holding out for some kind of fear trade, and especially if you've been long the VIX, the volatility index, then it's been phenomenally painful. One of the long-term trades, just to bring you guys in, that I've been involved with has been long gold. You know, I've been in it really since the beginning of 2016, and then I got out when Trump got elected, and I've entered gold twice from about this period. So really, if I just put the longer term gold positions I have on, one is about here and one is about here, which looks like a wonderful trade, doesn't it? It's not, however, because on this long position I bought gold. That means I bought gold in US dollars using pounds, and that was off the assumption that the pound after Brexit would not strengthen particularly aggressively, because obviously even though gold has moved higher, what has negated the trade that I've put on is the fact that the pound has also moved much higher versus the US dollar. So when you then make the exchange back between those two currencies, the long gold position net flat. So quite disappointing, to be honest. Anyway, ADP to look out for. That's coming out this afternoon. That will be the main one to look out for. Before that's 1:15. Before we get the US oil data coming out at 3:30. Relatively quiet in the markets, but as you saw in oil, things can happen and catch you unawares. For those guys who are new in the program, I'm looking forward to catching up with you today and being involved and trying to keep the learning journey going whilst anyone's logged into this trading live room. So thanks very much, guys. Have a good day. I'll speak to you shortly. Enjoy the session. Good luck with your trading. Thank you.